Yeah, good morning, everyone. Welcome to today's session in continuation of our discussion on earnings per share in line with the requirement of IAS 33. Okay, today we will be more or less looking at the requirement of IAS 33 with respect to diluted EPS. The first part of this was primarily on basic EPS, and we'll be looking at diluted EPS today. And as we try to look at it also, we'll try to recap the little discussion we had yesterday in the first session. Okay, let me go back to the material. Now you recall that we had this discussion on EPS that in line with IAS 33, we are to disclose basic EPS and diluted EPS. And in the first session of our part of this discussion, we've extensively discussed on earnings per share from the basic perspective. We said basic EPS simply is the EPS at current position without considering the existence of potential ordinary shares. We simply put that our basic EPS, as the case is simply our earnings attributable to ordinary shareholders, either of a single entity or of a parent company, as a ratio of the weighted average number of ordinary shares in issue. Okay, and also we went further to discuss that from a single entity perspective, our earnings will be considered from the angle of profit for the year, which is profit after tax, provided there is no preference share, or where there is preference shares and the preference share has been considered as a financial liability in line with IAS 32, such that the dividend, preference dividend, will have been deducted by way of finance cost or charge. And also, we use profit for the year, assuming there is no discontinued operations. Okay, but where there's a discontinued operations, we'll be considering profit from continuing operations. Okay, and also earnings where there's preference shares, which can be considered as an equity instrument in line with IAS 32. In that situation, such preference dividend will not have been deducted in arriving at profit after tax. Therefore, to determine the residual profit due to the ordinary shareholders, we then need to deduct preference dividend from our profit after tax. Now, from a group perspective, we'll look at the group profits, okay? And that is on the premise that the group has no non-controlling interest, which means the subsidiary is wholly owned. But where the subsidiary is not wholly owned, which created the existence of a non-controlling interest, we invariably have to deduct the share of non-controlling interest in group profits from our group profit after tax to determine what is residual to the shareholder of the parent entity. And likewise, where the group equally has preferential capital in the structure, we also deduct preference dividend and thereafter deduct NCI share of group profit before arriving at the residual earnings that is due to the shareholders of the parent entity. And likewise, if the group has a discontinued operations, the earnings we'll be considering will be the earnings from continuing operations, less the preference dividend, less the NCI share of profit. We also now look at the denominator, which means what form of ordinary shares are we considering and what brings about weighted average. The first thing is that we are only going to consider shares that have residual interest in the net asset of an entity. and such shares are characterized as ordinary shares. And these ordinary shares will have different classes. But for now, we only consider it to have a single class in which dividend rank shares rank pari passu for dividend in the company. Now, but one thing that is critical is that the ordinary shares will be considered based on the weight of the contribution of capital in every year in which we are having this computation. And that brings about the weighted average. And what weight are we going to use is based on time proportion. How long has that share stayed in the business to have contributed capital to generate the amount of earnings? That time proportion will be used as a weighting factor for determining our weighted average number of ordinary shares. Okay. Now, we also now consider that what are the factors that contributed to adjustment in determining the weighted average number of ordinary shares. We talked about new issues of shares at full market price. We talk about new issues at below market price. And we talk about new issues at zero cost or price, which are the bonus issue. Okay. Yesterday, on our first part, we've not discussed on treasury shares. Okay, we are going to look at it later today, or probably we'll start with it now, and probably later on we'll discuss on the share reconstruction. We can come by way of share splits, or what we call reverse share split, or what you can consider share consolidation. Okay, that is that, just to more or less buttress what we've discussed before now. And I think let me share a workbook and quickly discuss on treasury shares. Okay. Now let's look at our last discussion was on issuing shares below market price, which was considered a right issue. Now let me try and incorporate this question, and rather than consider it in this manner, I'll just copy this and I'll change the question. I'll consider it question 5. And what we want to do is to alter this question. And I'll alter it by trying to say, okay, I can call this scenario 5. Okay, now what do I want to change the question to? Now we can consider scenario 5. Okay, basic EPS with treasury ordinary shares, which means there was buyback, or call it purchase, I'm just calling it, there was buyback, buyback of 200 shares, ordinary shares on 1st of April 2019 at full market price. Let's just have it like that. Therefore, what will be our situation now? Therefore, if I'm to read this question the way it is, basic EPS with Treasury ordinary shares at full market price. Asna PLC currently has 1 million ordinary shares in issue as at the reporting date, 31st December 2018. The profit after tax for the year was 5 million. Now there was buyback of 200,000 ordinary shares on 1st of April 2019 at full market price of 4.25 Naira. Now, the year ended 31st December 2019. We are told to compute our basic EPS. Now, what simply happened is that our last reporting date before now was 31st December 2018, when the ordinary shares were 1 million in units. Now, in the current year, which is 2019, our profits for the year was 5 million naira. Now, the number of shares repurchased by the company remember, we've discussed extensively about share repurchase under IAS 32 under financial instrument. Now, shares repurchased as of 1st of April 2019 was 200,000 shares. Now, repurchased shares repurchased at full market price. Okay, and that is that. The reporting date is at 1st December 2019. Therefore, what is our basic EPS? As you can see, our basic EPS is our earnings attributable to ordinary shareholders, which is our profits after tax. But what's our weighted average number of shares? Therefore, we can use any of these two approaches. Now, let's look at the approaches one by one. Now, existing shares between December 2018 and December 2019 were 1 million. Now, shares repurchased as of 1st of April were 2 million shares. Therefore, what does that mean? Repurchase means you are reducing the number of shares, and that is negative in that scenario. Therefore, what happens at the end of the day is the existing shares is 1 million, and we repurchase 200,000. Therefore, what do we do in that situation? Now, as I've told you earlier, I said yesterday or in our first session that these two methodologies will produce the same answer, but the second methodology, when you get to complicated situation, it's much easier to comprehend and to adopt than the first methodology. Now, what I'll do now is let me start with the second methodology, and we'll come back to the first one. Now, the second one is saying that between the beginning of the year and when an event occurred, how many shares do you have? Remember, the year starts January, and on 1st of April, there was a purchase, which means prior to 1st of April, how many shares were existing? Between 1st of January 2019 and 31st of March 2019, we have 1 million shares. Now, from April 2019 to 31st December 2019, the shares has reduced. Instead of addition, now has reduced to 800 because of this repurchase. Okay, take note of this. Okay, therefore, it means we had 1 million ordinary shares for the first 3 months of the year, and we had 800,000 shares for the next 9 months of the year. And in that case, what happens? The 1 million, based on time proportion, will have a weight of 0.25. Multiplied by 1 million will give us 250. Now, the 800,000 for the remaining 9 months has a weight of 0.75. And multiplied by 800,000, you have 600. How do you determine the weight? 3 months and 9 months make up that whole calendar year of 12 months. Okay. And therefore, what do we do? What then do we do is that to find the proportion of 3 to 12, which is what we've done here, and also the proportion of 9 to 12, which is what we've done here. And the two sum up to 1 year. And that's how we're able to obtain this. And similarly, you find out that doing the same thing here is that we presume that first, the existing shares run for 1 year, which is 1 million, while this repurchased shares was repurchased 9 months to the end of the year. Therefore, we find the proportion of 9 months to 12 months, which is 0.75, of the reduction in number of shares to determine the effective weight of number of shares reduced, which means 150,000 shares were not in existence in that year, or because the 50,000 is considered to have been in existence, which is equal to 3 months of the entire number of shares repurchased. And at the end of the day, we have 850 apples. But as you can see, this methodology is much more simpler and easy to understand and appreciate as you even go more in a complex situation. Therefore, my weighted average number of shares is 850. And what is my basic EPS? It is 5 naira 88 kobo, which means effectively it is 850,000 number of shares that were able to generate this 5 million. And as a rank pari passu, as equal class, we are able to arrive at 5 naira 88 kobo. And this is how you treat treasury shares or situation where a company repurchases the shares. When such shares repurchase will be considered no longer to be in issue. And therefore, from the point it's no longer in issue in that year, up to the end of the year will be discounted out for determining the weighted average number of ordinary shares in issue. And that is the position there. In case you have any question, you could ask. But this is what you do. At every point in time, let me put it in red, where you repurchase is going to constitute a reduction. And it's equally, it will be affected by the time factor, as we've done it in this case. Okay, if there's any question, we can move on. Any question? Okay, since there's no question, therefore, that is that. Now, we'll come back to our discussion here. And probably I might find illustration to explain it also. The last aspect, the factor, is shares reconstruction. Okay, and we'll come back to that. And what does it mean? A situation where, okay, let me first of all explain share reconstruction there. When we have share splits, what do we mean? Share split is a situation where before XYZ PLC has 1 million shares at 1 naira nominal price. Okay, which means the share capital is 1 million naira. Now, what happened? The board of the company now decides to reduce the nominal price to 50 kobo. The implication is that since the share capital will not change or remains the same, hence the number of shares will then increase to adjust back to what the share capital is, which means if before your nominal value is 1 naira, it then implies that since your share capital equals nominal price times number of shares, since share capital will remain the same at 1 million, and nominal price is now 50 kobo, therefore, what is the number of shares? The number of shares will now increase to 2 million by dividing 1 million naira divided by 50 kobo, and that will give you 2 million shares. This process is what we call share split. Share split means that you are trying to increase the number of shares by not increasing the capital, but by reducing the nominal price. Okay, that is share split. Now, in any year there's a share split, it will invariably increase the number of shares, which is the denominator. This number of shares here, it will increase it, and thereby force the basic EPS to reduce. And if you compare it with last year, it will look as if your performance is poor, whereas it is not poor. Therefore, what do? Those are the things we'll discuss. Now, let me also now show you reverse splits. What I did here is what we call share split. Let me show you reverse split. Or what we call shares consolidation. Now, in the reverse split, this is what happens. ABC PLC has a share capital of 1 million naira. With a nominal value or nominal price of 50 kobo per share. Invariably, it has 2 million shares in issue. Now, the board of the company decided to consolidate 2 shares to 1 share, thereby increasing the nominal value or nominal price from 50 kobo to 1 naira per share. Therefore, what is the implication? The implication then is, since share capital is a function of nominal price and the number of what? Shares. Therefore, the share capital remains the same, and the nominal price is now 1 naira. The question is, how many shares will give 1 million naira? Is to say the number of shares is simply 1 million naira divided by 1 naira, and that gives me 1 million shares, which means the 2 million shares is now equal to 1 million shares just because the 50 kobo is now 1 naira per what? Per share. And that is consolidation, which then means that this year, when you are computing your basic EPS, your numerator will reduce by half and make your basic EPS increase by 2 times, which implies that it shows erroneously as if this year's performance is better than last year. But what then do you need to do? We need to go back to last year for comparative purposes and adjust as if that same share split or consolidation you did took place last year. The essence is to make it comparable, because otherwise you will have been providing wrong meaning or information to the shareholders. Therefore, now let's look at how do you do it. Now, for this share split, remember, what is the ratio? The ratio is that you reduce your nominal value by half, which means since you have reduced your nominal value by half, nominal value or price was halved. That is 1/2. 1/2 times 1 naira is what gives 50 kobo. Therefore, your comparative basic EPS, which is for last year, will be the basic EPS for last year multiplied by the reciprocal of this half. Reciprocal of the half. That is 2/1, which means if the EPS last year was 10 naira, it will now be 10 naira times 2/1. And that will give you your adjusted EPS. Now, because you have it. Now, let's now look at this. Here, your comparative EPS, which is for last year, will be basic EPS for that last year multiplied by the reciprocal of double. What is double? Remember, your nominal price was 50 kobo. What you did to bring it to 1 naira is that you doubled it. That is 2/1 is 2. That is double. Therefore, what will be the reciprocal? The reciprocal will now be times 1/2, which means if your basic EPS last year was 20 naira, you will now divide that 20 naira by 2 or multiply by half, and it should give you 10 naira. And that is the simple analogy we are trying to deduce to it, which means the ratio to which you reduce nominal value is the ratio you use to increase earnings per share. Which means if you reduce by multiplying by half, you will increase by multiplying by inverse of half, which is multiplied by 2. If you double the nominal price by 2 or 3, which is 2/1 or 3/1, you reduce the adjusted EPS for comparative period by the reciprocal of that 2/1, which is now 1/2 or 1/3 if it is 3, and that is the case here. Which means at every year, there is share reconstruction, you must do the needful by adjusting your EPS for last 12 year, which is a comparative period. And that is the position there for share reconstruction. Okay, that is that. Now, I think we'll refresh our memories on what we have discussed so far on basic EPS. Now, let's go back to the main point of discussion today. And we'll be talking about diluted EPS. And what is a diluted EPS? We are looking at the possible reduction in the amount of EPS in the future arising from the fact that we've entered into a contract today, or we hold financial instrument today that will give the holder a right to holding our ordinary shares in the future, probably by the time such right vests. And the consideration here is that it's more likely than not that the right will vest and such right will be exercised. And at that point in time, we consider such rights to contain potential dilution, where the contribution they might be bringing to the table may not commensurate with existing contribution, thereby eating out of earnings that's supposed to go solely to the existing shareholders. In that situation, you thereby dilute the existing shareholders' right to getting maximum dividend at a future date. And therefore, we say such shares are potential ordinary shares, and such potential ordinary shares could create potential dilution. But take note, not all situations will potential ordinary shares give rise to dilution. And that's why we are going to carry out an assessment of potential dilution. And it's only dilutive earnings that will be considered in the recognition of the weighted average number of shares for the sole purpose of computing diluted EPS, which means anti-dilutive potential shares will not be considered because they are more likely going to increase any participation of existing shareholders rather than reduce, or they are going to marginally cause an increase after getting to the most dilutive position of the earnings, which means the position of the standard is we are not just to disclose diluted EPS, we are to disclose the most potentially diluted EPS, which means the lowest ebb we can ever get to is what we are going to consider. And this is common where we have more than one class of potential ordinary shares that are dilutive in nature in the structure of an entity. Otherwise, if you only have one class of potentially dilutive ordinary shares, such issue of most dilutive position may not arise. But when we have two or more, we then need to carry out further analysis to determine at what point do we have the most dilutive position. And what does that mean? What it simply means is that we might likely plot a curve, plot a graph. Let me use different color. We might plot a graph. This axis might look at the number of classes of potential ordinary shares. Like this, we look at changes in EPS, which can be in Naira. And therefore, if we look at the count, if there are one, the second one, the third one, the fourth one, let us say the fifth one. Now, after ranking, we might find a situation where the first one might be here, the second one might be here, the third one might be here, and before you know, the fourth one might be here, and the fifth one might be here, which means when you look at this, and we plot this curve, we'll find out that initially, the curve is downward sloping, but got to this point, which is the lowest ebb. And this lowest ebb is like the point of inflection. And this is more or less like the minimum level. Therefore, the question then is at this point we stop? This is the most dilutive position. And therefore, what it means is that we only consider these three potential ordinary shares in the computation of diluted EPS, which means we will not take cognizance of this other two because this is the lowest ebb that we have. Which then speaks to the fact that our earnings per share cannot get lower than this level Any attempt to consider 4 and 5 will even increase it, which means no, we are looking at the most loss to existing shareholders that will ever happen is at this level. All other things being what? Equal. And that is what we are trying to do in that. And that forms one of the questions I can ask that, okay, in determining diluted EPS, what are the steps to be taken in determining that? And we are still going to look at all of those things today, practical demonstration. Now, what are things that constitute potential ordinary shares? As I explained in part 1, potential ordinary shares are ordinary shares that currently are not in existence, but we have entered into a contract that could give rise or create these shares in the future upon vesting or maturity of those contracts. Usually, these contracts are contracts by way of financial instruments, and sometimes it might be by way of normal trade contracts. But the instruments that are usually common to creating potential ordinary shares, which we are also going to consider today, are convertible securities, such as convertible debt, convertible preference shares, shares, options, and warrants, share grants. We are going to look at that also. Employee stock purchase plans, they are also within the same bracket of share options and grants. Contractual right to repurchase shares at any point in time, which is like a puttable share option. Okay, and also contingent issuable contracts. Okay, and we're also going to look at that, which much more is paramount towards business combination, where you have consideration to issue shares at a later date by way of contingent consideration, but it involves shares rather than involve cash payments. All of these are what we are going to consider at this time. Now, on this basis, we'll go back to the tax I gave you yesterday, and I wish you guys will, if you have not done it, you do it now, and we'll convert back in 30 minutes to consider what we've done so far. Okay. If that is the case, I'll be back by 11:30 to discuss the solution. Here, what we've done is that we have situation where we have about 3 different transactions that impact our basic EPS. And therefore, if we are in this situation, probably an examination, or how do we attempt it? Okay, 25 minutes. We can start now. Thank you very much. Okay, we are back. Sorry, the last time I did not share this what's it called? This drawings with you or my chatting. Okay, what happened here is that I tried to explain the position of the standard by showing the most dilutive position. I said we have the y-axis that shows our EPS. Okay, in that case, I call it change in EPS, which means we are looking at how dilutive our EPS is. Now, we said if you have about 5 classes of potential ordinary shares, now we have considered them to be dilutive in nature. We will now consider the effect of them one by one after ranking. which means on this basis, we have ranked them as 1, 2, 3, 4, 5, which we are going to see. And on the ranking, we'll say, if we pick the first topmost ranked and we incorporate it in our basic EPS, what amount of diluted did it give us? It gave us this. By the time we combine it with the second one, it gave us further reduction. By the time we combine it with the third one, it gave us another reduction. But by the time we combine it with the fourth one, you find that what has happened is that instead of reducing, there's a change here coming up, which then means that this point is a point of inflection. And therefore, by the time you move further to the fifth rank, because later on when you see this ranking, we are ranking it based on which one has the potential, maximum potential to reduce our earnings. And that's what we're trying to do. And at the end of the day, you could see that it's moving up the ladder again. And therefore, we discountenance this point and take only these points. And what gave us the lowest end is by the time we combine 1, 2, and 3. And therefore, this point is the most dilutive position, which we have to report as our EPS, which means the EPS here is our diluted EPS, which gives us the most dilutive position. And that's what we are talking about. Okay. Now let's leave that and try to solve our question. Now, before solving the question, there's something I want to point out to us again. Now, remember, when we did bonus issue, we tried to consider two methodologies. I'll also now introduce the third methodology, which is also critical to us in our discussion. And what is methodology? The methodology is to combine, since it's only bonus issue that occurred during the year, I will look at it from the beginning to the end of the year. Therefore, remember, how many shares are there before bonus issue? 1 million, and there was no new issue. Therefore, the time span here is 12 months from 1st of January 2019 to 31st of December 2019, 1 million ordinary shares. Now, the only thing we now do here, in addition to the time factor, is to have the bonus factor. Now, we'll come here, we have the bonus factor. Now, what is the bonus factor? We'll go back here. Bonus was given of 1 for every 10. Now, remember that bonus factor and adjustment factor are inversely related. Recall that bonus factor and bonus adjustments are inversely related. What does that mean? What it means is that if our bonus adjustment is existing shares over existing plus bonus, hence my bonus factor will be the reverse. And what is the reverse? The reverse will be my existing shares and my bonus is 1.1. or I can use the units as the case may be, which is still 11. And my existing is 10. And what ratio will this give me? It gives me ratio 11 to 10. I remember what I said here, this issue of less than 1 and this issue of greater than 1. And that's the same thing that is playing up here if there is existence of bonus. Therefore, what do? We adjust for this bonus factor, which is this here. And we apply the bonus factor. And that gives us 1.1, exactly the same way. Which means in this case, we don't need to therefore, in this case, we get the same answer rather than adjusting for the bonus here. Which is the same thing we've done there. Okay, now the principle here is what we are now going to adopt to solving the problem here. Now, can somebody volunteer to read this question? Somebody said the camera is blank. Is it blank? So is it blank? Can somebody answer? Okay, thank you. Joy said it's not true. Probably you are using phone or your laptop, check it. Okay, now let's go back to our question. Now let me extract the information and let me just use what I have here. Now, on 1st of January 2015, $2 million shares. Profit for the year, 2 million shares issued. Okay, on 30th of April 2015, they issued additional shares. New shares issued on 1st of April. On 30th of April, not 1st. 2015. 270 million shares. Sorry, 270,000 shares. At full market price, we don't need a price, but we know that it's at full market price. Okay. We also issue on 31st of July. New issue as of 31st of July. But that's below market price. Which is a right issue. Therefore, the right price was, I'll change it to Naira, forget the dollar sign, was 2 Naira per share. And the right ratio, the right conversion ratio of 1 to 10. 1 to 10 shares. Okay. The fair value of that's the commodity price. The fair value of the shares on the last day before the shares were issued was 3 Naira 10 kobo. That is market price as of the time the right was issued was 3 Naira 10 kobo. Okay. Finally, on 30th September, the company made bonus issue. Bonus issue on 30th September 2015. Bonus conversion rate one for 20. Okay, somebody said my camera is blank. Okay, let me stop and share again. Can you guys see it? Please, can you see it? Please kindly confirm. Okay, thank you. Okay. Now, the profit for the year was 400,000. $400,000. Okay, you said my face is not showing. Can you see my face now? Can you see my face? No. And it's only my face cap you are seeing. Okay. Okay, maybe you see my face now, but let's continue. Can you now see my face? Okay. Yes. Okay, thank you. I don't know what went wrong then. Yes, bonus issue, that's 1 to 20 shares. Now, reported earnings for last year, earnings for 2014, 31st of December, 2014, was 18.6. That's 18.6 P. Okay, let's leave it like this. That is, sorry, in dollars, that's 0.186. That is about 19 kobo. Okay, that is it. 8.6 pence, that's what it is. Now, we are told to calculate our EPS as of December 2015. Now, I've extracted all this information. Therefore, I'll make use of this table. This last table I showed you earlier. This table, I can call it approach C. The table will be much more useful to me. And I needed my templates. These are my templates. Okay. Okay. Where's this other one? It disappeared. Okay. Okay. Now let's start. The year started 1st of January 2015 with 2 million shares. Okay, I'll come here 1st January 2015 to a day before the first event. The first event was on 30th of April 2015. Therefore, in this case, we have shares issued on 30th, which means between 1st of January to 30th, we had 2 million shares in existence. I'll put here 30th April 2015. Then I can put a remark, existing shares. And how many are they? They are 2 million. Now, between 1st of May, which is after 30th, and 31st of July, between 1st of May 2015 and 31st of July 2015, we have existing plus new shares. Which means the 2 million shares plus 270. That gives us this. Now, between 1st of August and end of the year, we had new right issue. Therefore, 1st of August 2015 till end of the year, there was no new issue other than bonus. Therefore, I'll say existing plus new shares plus rights. Now, the question then is, they didn't give us the right issue shares, but they gave us the ratio. Therefore, ratio of 1 to 10. Ratio of 1 to 10 of shares existing as at when the right was issued. The question then is, how many shares were existing as at when the right was issued? Let's come here. Number of rights in shares. Rights issued in units was 1 share existing shares in units that qualifies is 10. Therefore, the question then is, as at 31st of July 2015, when the right was issued, how many shares are existing? Or let me say are in issue. How many shares are in issue? Remember, how many shares are in issue? It is this 2 million plus the new shares issued about 2 months before that date. Therefore, what do we have? These shares. Hence, right shares equals 1:10 times this existing. And that gives us this. This is the amount of rights. Sorry. This is the amount of right in shares. Now we take that in here and say this is a cumulative of existing and new plus the right which we have here. That gives us this, which means as at the end of the year, this is what's supposed to be. Now we are coming back to bonus. What if this time span between 1st of January and 30th of April, that is 4 months. Between 1st of May and 31st of July, that is May, June, July, that is 3 months. And between August to September to December, that is 5 months. And when we add all together, that should give me 12 months. Okay, now what's the fraction? 4 out of 12. What ratio is that? And that's the ratio. Okay. Okay. Now, what happens in this case? What's the bonus factor? We'll come back to that. Now, if you remember, there's a thin line here. When the right issue was issued, let me drop a line here. Okay. Let me use this. I'll tick it this. Okay. Now, a period before right was issued, we need to determine theoretical extra price. We'll come here. Let's just pick the units, since that is information we have. I can copy this and put it here. Therefore, what do I need? If I'm using the units, it's very simple. Now, if I use the units, it's going to be how many existing shares? We have it here, 10. How many rights? 1. What price? The cum price. This is the actual price of the shares before the rights. And the right was issued at 2 naira. Therefore, this gives me this. And I can come here and say, my full market price plus rights is 33 divided by my shares. It gives me 3 naira. Now, if I use value, I have existing this, sorry, existing here this, and have my rights this. That gives me this total value. Remember the price was 3 naira 10 kobo, and when the right was issued was 2 naira. It's still going to give me the same result of dividing this by this. Now, what matters to me is that I need my theoretical extra price, both in units and in value. Now, this will allow me to determine my bonus factor. If you remember, we had the bonus factor here. Therefore, I can determine my bonus factor. And what's my bonus factor? Is my cum right price divided by theoretical right price. What's my cum right price? The price of the shares before the right was issued divided by the weighted average price, which is 3 naira. And that gave me this, which I said will be greater than or equal to 1. Now, this factor, I'll bring it here as a first bonus factor. Or I can say this is a bonus factor that this will be the right issue. This will be the right issue. Okay. That's the bonus factor. Now, what's the bonus factor? we apply it to all existing shares before the right was issued. We apply to this, we also apply to this. Now, we also have the second bonus factor, but that one is for bonus issue. If you remember, when we did bonus issue, we said we need a bonus factor that talks about existing shares plus bonus issue over existing shares, which is the reciprocal of bonus adjustments. Therefore, we need bonus factor for bonus issue. Recall, this is for bonus issue. Now, what's the bonus factor? As at the time bonus was issued, for every share, for every 20 which are existing, you have additional share, which is 1. Therefore, let me create it here. Existing and bonus issue. Therefore, for every existing 20, according to the question, you get 1 bonus share, which means it's going to be this. Hence, it will be ratio 21 to 1. And therefore, ratio 21 to 20, existing 20, and that is 1.05. Now, this 1.05 will be applicable to all of the shares, which means I'll put this one to be blue. And I'll create line for blue. Line for blue will affect everything to the end of the year. Sorry. I'll change this color to blue. And this is 1 because there is a cutoff. And this, there's no cutoff. This is 1.05. Let me change this to blue so I can show the link. I'll change this one to red. It will show the link. Therefore, this same blue and this same blue. And therefore, the product will now be the number of shares multiplied by the time fraction, which is a weight, multiplied by the bonus factor for right issue, multiplied by the bonus factor for normal bonus issue. And that gives me this. And that gives me that. Therefore, I can sum them up to give me the weighted average number of shares. Sum this up, it will give me a full year. Otherwise, there's a problem. Therefore, this is my weighted average number of shares, 2431508, which I'll come here and say, my earnings per share is my earnings, which is 400,000, divided by the weighted average number of shares. And therefore, this will be 400,000 divided by this, and it gives me this. Now, this are in shares. And that is it. 16 kobo. Now, if you compare 16 kobo with 19 kobo, it will look as if last year is better, but we need to do something, make bonus adjustments. Now, I'll call it adjustments here. Why? Because there are two things that happened. There are two things that happened. There are two things that happened in 2015 that has bonus inherent. The first one is the right issue. And the second one is for bonus what? Issue. Therefore, there are two adjustments that I have to make. And what will it be? It will not be this one is a bonus adjustment for right issue. I'll also not do bonus adjustments for bonus issue. Remember, this was in red, and the other one was in blue. Before blue, let me just copy it. Okay. Okay, now what do I need? Remember, it's reciprocal. Here, bonus factor for right is cum on top, and theoretical S right on beneath. But now this will be on top, as you can see, and the cum right price will be beneath. They are inversely related. Same way, for bonus adjustment for bonus issue, existing share was beneath but not on top, and existing plus bonus issue that was on top before will be beneath, and that is it. Therefore, theoretical SI price, which is 3 naira, cum right price, 3 naira 10 kobo. Existing shares, which was 20, now existing for plus bonus in shares, which is 21. Now let me take this is in shares, while that is in naira. Okay, and this is a factor. Therefore, it means the adjustment factors are 2. It means the 19 naira multiplied by the first factor multiplied by the second factor will give me 17 naira, which is still higher than 16 naira. Therefore, in that case, last year seems to be marginally better than this year, which means my basic EPS in 2015 is 16 kobo, while adjusted EPS in 2014 is 17 kobo. Therefore, who want to speak to this answer and who got it correctly? Kindly raise up your hand so that I can allow you to mute to unmute and make your commentary, or who have a question on this. Who has a question? Okay, no question. Therefore, this is just to buttress the assignment which standing as a classwork that I equally gave you guys. Okay, that's the position. Now, we can now move to diluted EPS problem. Now, let's go back to our material. Now we look at the question one by one. But before then, what constitutes diluted EPS? What constitutes diluted EPS is first our basic EPS. If you remember, I made mention that diluted EPS will reinvent the wheel from the basic EPS. And what is basic EPS? The earnings attributable to ordinary shareholders, as you can have it under basic EPS. And likewise, the weighted average number of shares as we have it under basic EPS. The only difference is that numerator may be adjusted for increase in earnings attributable to the conversion or to the existence of potential ordinary shares. And we're going to look at what could bring about that. And likewise, the denominator will also be adjusted for weighted average number of potential ordinary shares, which means what we have as basic EPS subject to X adjustment in the numerator and subject to Y adjustment in the denominator. Okay, now if that is the case, let me copy that and use it to explain one or two things to us. Now, what it simply means is this. Our basic EPS is simply earnings attributable to ordinary shareholders divided by the weighted average of ordinary shares in issue. Now, we're not saying diluted EPS is this basic EPS less the dilution. And this dilution is equivalent of the change in the EPS. And the change, I'll do it as a reduction. And I'll use red for it. And this change in EPS is determined by increase in earnings as a result of potential ordinary shares. And I'll put if any. If any means that not all times there can be increase in earnings as a result of potential ordinary shares, divided by the weighted average number of potential ordinary shares, which I'll call this X, I'll call this S, and I'll call this Y, which means the change is simply X over Y. And those are the things we are going to address as we move on. Now let's look at the first scenario we are going to look at. Let's look at where we have convertible securities. I'll come back to scenario 5 later for contingently issuable shares, but I'll focus on scenario 6. Can somebody read scenario 6 for us? Can somebody read scenario 6 for us? Samuel. Over to you. Are you there? Okay. Ifeanyi, over to you.
Hello, sir. Where I'm not around is very noisy. I don't know.
Okay.
I'm on the road.
Okay, no problem. Who else? Ilori, over to you.
Scenario 6, basic EPS and diluted EPS with respect to convertible securities. On 31st December 2018, Sanchez Limited had 1 million ordinary shares in issue of a par value of 1 naira and 8,000 convertible bonds of 100 naira. The bonds bear an interest rate of 5%. Each bond is convertible into 2 shares. The after-tax profit for the period is 4.6 million naira. The income tax rate is 40%. Required. Calculate basic EPS and diluted EPS for 31st December.
Okay. Okay. Now let me switch it to my workbook. Now I'll bring out information here, which is synonymous to okay, on 31st December 2018, Sanchez has 1 million shares at nominal value of 1 naira. Okay. Also has number of loan notes, convertible, bond notes. How many? 8,000 units. Okay. 8,000 units. What's the nominal price? Bond nominal price. Bond nominal price is 100 naira per bond. Yeah. Bond bear interest, coupon rate. Annum, 5%. Each bond, convertible rate, conversion rate of bond is 2 shares to every bond. That is every 100 naira bond for every 100 naira bond for 2 shares. Okay. Profit after tax is 4.6 million. And income tax rate is 40%. Therefore, calculate basic EPS. What's our basic EPS again? Basic EPS is this. For 2018, our basic EPS is our earnings per share divided by weighted average number of shares. There have not been increase in shares, nothing. And therefore, the weight is 12/12, no problem. And this is 4 naira 60 kobo. Now, next, we are told to compute diluted EPS. Our diluted EPS will now be earnings, which is the same thing we have as per basic EPS, plus increase in earnings, which I'll put in red. And what is that? These are the adjustments we need to make. And for what purpose? We'll see that. Also beneath, we use our ordinary shares the same way we have it as per basic EPS, plus the weighted average number of potential ordinary shares. And therefore, that's the Y adjustment that we are also making. Therefore, this is our new position. Therefore, what will it be? We don't know yet. Sorry, I think my internet went off. Yeah, I've reconnected to another one. Sorry, my internet went off. Okay. Now, What then do we need to do? This is our X. And this is our Y. Therefore, I'll come here, my X, which is increase in earnings. How do I arrive at this? Now, the issue here is my ordinary shares is 1 million shares as at the end of the year. And my number of bonds in issue is 8,000, of which one is 100 naira per one. Which means if you want to know my bond value, convertible bond value, it will be 100 naira times 8, which shows 800,000. That's my bond value. Now, this bond value of 800,000 has a coupon of 5%. Invariably, what will be my interest on bond? My interest on bond will be 800,000 times 5%, which is for a year. Now, this bond, if I convert these shares, this bond to shares, will I still be paying the interest? The answer is no. Which means if I no longer pay that interest, what will happen to my profits? My profits will increase. Because once you convert bond into shares, you will no longer pay interest, which means the interest will be added to your existing profit to boost it. Going forward, you won't be paying interest. Therefore, that is an increase that is coming to your earnings. But remember, there's an advantage in bond because of the tax savings that exists. Every interest in bond is tax deductible. Therefore, if you are no longer paying interest, you will not enjoy tax deduction on that interest, which then means that as you gain the 40,000, you will lose the tax benefit associated with interest on bond, which then means that I will less the tax effect on the interest savings that I have once the bond is converted into shares. Therefore, the interest savings is at the rate of corporate tax, which is 40%. That is what I will lose. It means net, what I'm saving is 24,000 net of tax. Because I can't eat my cake and what? Have it, which means my net interest savings is now what I consider as my what? My X. And that is what you need to take into consideration. Therefore, my X is 24. Now, what is my Y? My Y is the weighted average number of potential ordinary shares. What are the potential ordinary shares? The potential ordinary shares are simply that if I have number of bonds to be 8,000 units, and the conversion ratio, which we have here, is for every bond, you have 2 shares. It then means that my number of shares potential ordinary shares is equal to, if 100 naira bond, which is a unit of a bond, we have 2 shares upon conversion. That means for the 8,000 bond, you have 16,000 ordinary shares. Now, but this 16,000 ordinary shares is not the Y, because you need the weight. The weight in this case is 12 months over the 12 months. What does that mean? The weight in this case means that the bond has been existing as at the beginning of the year, and naturally it will have earned interest for the whole year. And therefore, if you are converting, it's presumed that he has produced capital for that whole year, which means it is still 12 over 12. And 12 over 12 is 1. That is the factor, which means invariably, my weighted average number of potential ordinary shares, which is Y, equal to the weight times the potential, which is this. But this is in shares. Therefore, what is my change in EPS? My change in EPS, if you remember, I said it's my X over Y. X over Y. And what is X? X is my increase in earnings, and Y is my weighted average. Therefore, what is X over Y? This is it. And therefore, what is that? 24 divided by 16. And what does that give us? Change. In EPS. That gives me 24 divided by this. 1.50 kobo. Now the question then is, how do we know the potential shares are dilutive or are dilutive? How do we know the potential shares are what? Dilutive. The potential shares are dilutive if the basic EPS is greater than the change in EPS. Now, what is the basic EPS? The basic EPS let me put it in blue. And the diluted, sorry, the change in EPS, let me put it in red. Now, in this case, Which one is greater? Between basic, 4 naira 60 kobo, and change in EPS, basics is greater. Hence, it is dilutive. Our answer here would then mean that since basic EPS of 4 naira 60 kobo is greater than change in EPS of 1 naira 50 kobo. Hence, it is dilutive. And once it is dilutive, what do? You include that. We include that in the computation of diluted EPS. And what is the computation of diluted EPS? Is for us to now incorporate the X and incorporate the Y. And you see it now. Now, what is the X? It is, our numerator now will be earnings, which we have here before, 4.6 million, plus our increase in earnings, X, which we have here, net interest savings, 24. That gives us our numerator. Our denominator is our ordinary shares we have before, which is this, plus weighted average number of potential shares, which is our Y. This is Y, 16. And that gives us this. Next is that my diluted EPS will reduce amount of 4 naira 55 kobo. Can you see? It reduced. Now let me imagine and see what will happen. Imagine our conversion rate here is not 2 shares, it is 3 shares. What will have happened? It's still dilutive. That's why it's reducing. It's still dilutive. Now, let me say it is 1 share. It's still marginally dilutive. Can you see? Let me now say it is like 0.5 shares, half a share. Now you can see that it's anti-dilutive because here the potential shares are dilutive if basic earnings per share is greater than change. But in this case, it is lower, therefore it is anti. And you can see that instead of our share price to reduce, it's going up, which is a proof that it is anti-dilutive. And that is how you determine that. This is a test, which I'll call test for dilution. Test for potential dilution. And that's the test we have carried out there. Now I'll return this to 2 shares. And that is it. Okay, now to refresh your memory, what did we say? We say simply, sorry, let me take this back. We say simply that our diluted EPS is our earnings as we have computed it before, plus increase in earnings, if any, divided by ordinary shares as we have computed it before, plus increase in shares based on the weighted average number of potential ordinary shares. And to determine the increase in earnings, you look at the interest you will have forfeited, which is a savings, but you will lose the tax effect on it. And net is what you will have saved, all things being equal. Weighted average number of shares for potential shares is first, what is the conversion ratio? How many shares will the bondholder get when they convert? It's based on what has been agreed. And again, we consider the weight how many months in the year do you believe the bond would have been in existence for by contributing capital to our earnings, to generating our earnings? Is 1, because the bond has been existing from the beginning of the year, which means if conversion has taken place from the beginning of the year, it will have ranked pari passu with every other shareholders, and that's why it's 1, and that's how we have it here. Now, at the end of the day, we try to determine change in EPS as X over Y, and that change resulted in 150 kobo. And we are saying that for us to know whether it's dilutive or not before jumping to computation is that we compare our basic EPS, this blue, we compare it with our change in EPS, which is this red. Wherever our basic EPS, which is blue, is greater than change in EPS, which is red, it means there's a potential dilution. Otherwise, if it is equal to or it is less than the change in EPS, it will be anti-dilutive. And that is it, which means our solution ends here. And this is our basic EPS. And this is our diluted EPS. Any question before we look at where we have more than 1 or where we have time apportionment? Any question? Okay. If there's none, let's go back to our question. And let's look at question 7. Scenario 7. Basic and diluted EPS with respect to convertible securities. Now, can somebody read this illustration 7? Who is Samsung? Okay. Precious, over to you.
Illustration 7. Okay.
Okay.
On December.
Continue.
Okay. On 31st December 2018, Sanchez Limited had 1 million ordinary shares in issue of par value 1 naira. The company equally has 8%, 10 million naira convertible debentures being in the issue since 2016, with an option to convert to ordinary shares on the following basis. 2020, 1,000 naira debenture note convertible to 35 shares. In 2021, 1,000 naira debenture note convertible to 55 shares. 2022, 1,000 debenture note convertible to 40 shares. And 2023, 1,000 naira debenture note convertible to 30 shares. The after-tax profit for the period is 1.8 million naira. The income tax rate is 30% required. Calculate basic EPS and diluted EPS for 31st December 2018.
Okay, thank you. Now, I've copied it and I'll try to adopt the templates of the other one we've done, only that I'll change the information where necessary. Now, ordinary shares, that's the second question we'll be solving. Now, ordinary shares in 2018 is 1 million. It has not changed at par. Company has issued 8% convertible. 8% convertible. We don't know the number of notes, but in this case, we know that it has 10 million. And what is the nominal price? It's 1,000 per bond or per debenture, 1,000 per debenture. This convertible debenture notes. Therefore, automatically, we will now be calculating we'll be calculating the bond. How many bonds we do? If you have 10 million naira bond or debenture, and it's 1,000 naira per debenture, how many units of debenture will you have? Is to divide 10 million by 1,000. And how many notes do you have? You now have, this is one we derive. We have 10,000 notes. That's number one. Number two is that this debenture has been issued since 2016. And when it was issued, option was given such that in 2020 is the first year they can ever think of converting. And if they decide to convert in 2020, they've estimated that the conversion ratio is 35 shares for every debenture note, which is at 1,000 naira per note. Otherwise, if they missed out in converting in 2020, they have option of doing it in 2021. And if they are doing it in 2021, they can only do it as 55 naira, 55 shares per debenture note. Otherwise, if they don't do it in 2021, they are likely to do it in 2022, but then it will have come to 40 shares per note. And the last time they can do it, which means that's the end of it, otherwise they redeem the debenture and pay you, is that they can convert it last in 2023 at 30 shares per note. Now, how do they get 35, 55, 40, and 30 is outside the scope of our discussion, because they might have projected into the future based on various scenarios, and they've come to this agreement. These are things you will learn in strategic financial management in terms of how do you look into the future to determine agreement and the likes. Okay, sorry, the person, I think I did disable my annotation. Therefore, I've done that now. Somebody tends to write on my note. I don't know why people do that, but I can erase it from here. But you can't do that again. Thanks to technology. Now, at the end of the day, the question then is, today is 31st December 2018. We still have 2 years, 3 years, 4 years, and 5 years to go. And as of 2018, if we are to compute our diluted EPS, what will you consider is a likely period these people will convert, and why? Remember, we're in 2018, and they still have up to 2 years in 2020, or 3 years, 2021, or 4 years, 2022, or 5 years, 2023, to convert. The question then is, what do you expect? Which year do you believe they are likely to convert, and why? Please raise up your hand if you want to answer that question. Which year do you believe? Imagine you are a bond holder. You are the one that invested in the debenture. Which year will you likely want to convert, if you want to convert, and why do you want to do that in that year? Any question, any answer? Okay, since there's no answer, a rational investor will likely convert in 2021. And why? All other things being equal, without knowing what the market price might be, he believes that 2021 will give me more amount of shares if I'm to convert than any of those other years. And take note, all other things are constant in terms of the share price of the company, which means we assume the share price will not be materially different from 2020, 21, 22, 23. That will have changed the situation, or because nobody can predict what the price will be there. In that case, what will now result to as our conversion ratio for every 1,000 naira bond is 55 shares. Take note of it. It's 55. How do you arrive at 55? Remember, the 55 was obtained from this. Take note of it. That is how you determine that, because the assumption you make is all other things being equal. What will give the debenture holder maximum benefit with respect to number of shares he will get is what will influence such person to determine the period of conversion. Now, tax rate here is 30%, and the profit for that year is 1.8 million. That is that. Now, let's now compute. Basic EPS is our earnings, which is 1.8 million, and our weighted average number of shares, which is 1 million, and that is 1.80 kobo. Now, but how do you determine diluted EPS? Please forget what is here. And let's come here. Increase in earnings. The bond value is 10 million. The coupon rate now is what's 10%, no, 8%. I have to change it, 8%. Now the 8% multiplied by 10 million means I'm going to save bond of 800,000 naira. But as I save 800,000 naira, I'll lose the tax benefit, which allows bond to be tax deductible from interest perspective, which means in this case, I'm going to lose 240 tax benefit since I'm no longer paying interest. Net, what I've saved is after tax of 560. Now, again, we'll come back. How many bond notes do I have? Remember here, 10,000 notes. I will derive it. 10 million divided by 1,000, that's the nominal value of the bond. Now, this 10,000 notes, I can convert as 55, which we have determined there. And that means that the potential net shares is 550,000 shares. Now, remember, this bond has been there prior to 2018. Therefore, it has stayed a full year calendar. And that time, it will still be 12/12, which is 1, which means my weighted average of potential net shares is 550 shares. Now, I need to determine change in EPS, which is my X over Y, which is 560 divided by 550, which is 1.2 kobo. Now, I need to carry out a test and say, the basic EPS, is it greater than change in EPS for it to be dilutive? Now, my basic EPS is 1.8. My change in EPS is 1.02. This condition is satisfied. Therefore, since my basic EPS is 1.8, which is greater than 1.02, therefore it is dilutive. Since it is dilutive, I can now come here and say, okay, my diluted EPS will be earnings, as I have it here, plus my net interest savings divided by shares, as I have it here, plus my weighted average potential net shares. Automatically, that will give me this. Sorry, what do I do? That will give me 1.52 kobo. That is the level of reduction that has come in. Why? Because it is dilutive in nature based on this test. Now, again, let me now imagine that you don't understand why we are picked 55. Let us pick 35 and see what the position will be. 35 gave us 1.75. It is still dilutive. And it has passed the same test here. But the level of dilution here is better than the other dilution because it means this is not the most dilutive position. Which means if you draw up the curve here, let me draw up a curve here. If I draw up a curve here, that means that if I pick year 2020, year 2021, year 2022, and year 2023. Yes. Now remember, my basic EPS is 1.8. That's my starting point, 1.8. Now, my diluted EPS, which is a reduction in basic EPS. Now, if I pick 2020 at 35, it gave me 1.75, which means 1.75 will be somewhere here. Let me pick 2022, which is 40. That gave me 1.69. 2022, let me say 1.69 is here. Let me pick 2023, which is 30. It gave me 1.82. Now you can see 1.82 is even giving me higher than basic, which shows that this is even a no-no. And let me go back to what we picked, 2021, which is 55. And before that, 2022 shows that it's anti-dilutive from day one because 187 change is greater than 180, which fails this test totally. And that's why this is totally out of it. This one is out of it because it is anti-dilutive. Okay, now let me now pick 2021, which is 55. I'll put 55 here, and it gave me 1.52. Now 1.52 is somewhere here. Now look at the curve. It's going down and it starts to go up. The question is, where is the ebb? The ebb what happened? I think I wrongly deleted it. Hang on. I wrongly deleted it. Let me come back here. This is now this point. This point here. Which we are going to trace to this point, is what gave us 150. Sorry, 55. Is what gave us 150, 152. This is the most dilutive position. Most dilutive position, 152. This one gave us, and this one gave us, I think this is 169, 1.69. This one was 1.7 something, and this one is totally out of it, 1.82. This is out of it because our basic is this. Therefore, anything above basic is a no-no. No-no. But anything below it is a yes, but we'll pick the most dilutive position there, which is this. Now, let me go back. Now, let me go back to year 2020, that's 35. Let me pick the point, that's 175 here. 175. This is 1.75. Therefore, what we are going to pick is 1.52. That is a worst scenario. And that can easily be known from here, from what we've done here. That is that. Okay. Now, any question at this point? That is the answer to that. We are able to determine the most dilutive position, and we are able to disclose basic EPS of 1 naira 80 kobo, diluted of 1 naira 52. Okay, now let's look at another example. Let's look at the third one. Now, can somebody read scenario 8? Ayla Ramon. Okay, Joy.
Hello? Hello?
Okay. Over. Yeah, read scenario 8.
Hello?
Okay, we can hear you. Read scenario 8. Otherwise, okay, Joy, go ahead, please. Joy, go ahead.
Hello?
Joy, please go ahead.
Scenario 8, basic EPS and diluted EPS with respect to convertible securities. Given the information in scenario 7 above, but the 8% 10 million naira convertible debentures were issued during the reporting period, i.e. issued on 1st April 2018.
Okay. Thank you. Now, what they are saying is this. What we have just finished, they are now twisting the question that they twisted it in this way. They said, given this scenario, I think let me put it under. Okay. Now they said, I hope you can see my screen. Now they said, given the same scenario we just finished now, but the 8% 10 million naira convertible bond were issued during the reporting period, and it was issued 1st of April, which means this debenture were issued on 1st of April, 2018. If that is the case, the only difference there is that it was 4 months, 9 months capital he has contributed, which means the money has only worked in that year from 1st of April to 31st of December, given that the year runs from January to December. Therefore, what happens? Which means the interest we are going to compute here is interest for 9 months, not for 1 year. Because in that year, remember, it's the same 2018 that we are computing that the loan came in. If it has come in 1st of April 2017, it's only going to affect 17 computation, it won't affect 18 because as at 18, the loan will have been there from January to December. But in this case, the loan was there for the first time, 1st of April, the current year we are computing, which means it would have contributed to our earnings in January 2018, February 2018, and March 2018. Therefore, interest that we also pay will be for 9 months, not for 1 year. Therefore, the interest we'll have saved is for 9 months, which means I'll just multiply it by 9 months divided by 12, which means I'm prorating the interest. And the tax effect on it will be on that interest, which means my net savings for that 9 months is 420. Now, the debenture note also, my weighted average here is not critical now. Let me put in it. And I put it in, let me say, wine color. Now, it's no longer 1. Why? Because it is now 9 months over 12 months, which means 9 divided by 12 is 0.75, which means my weighted average is 412,500 and not 550. In that case, my change in earnings is 420. My weighted average potential net shares is 412,500. And what do I have? Change in EPS is still 1.02, which is still lower than the basic EPS, which means it's dilutive. What then will I do? I bring it here. My 1.8 plus my 420 will give me 220. And my 1 million plus 412,500 will give me 141,500. And therefore, it gives me 1.57, which is slightly different from 1.52. Yeah, because of the 9 months effect and not a full year effect, which means the level of reduction will have been offset by the 3 months that the capital is not in the business. Does that make sense now? Did you see the effect of weighted average? Because it's going to consider the time proportion from all of the discussions we have been having before now, which means the same question, only that they treat it in such a way that we consider the time value of money. And that's what we've done here. Any question? Okay, if there's no question, then let me now give you question 9 to solve, and I'll send this template to you on the WhatsApp, and you will return here by 1:50, which means I'll give you like 20 minutes. I'll give you like 20, you return here 1:45 with your suggested solution. Now you are going to solve question 9. Question 9. Can somebody read question 9 before we solve it? Glory, kindly read question 9. Can you see it? Can you see it on the screen?
Whereby PLC has 5 million ordinary shares of 25 kobo in issue, and also had in issue in 2019. 1 million is 14% convertible into stock, convertible in 3 years at the rate of 2 shares per 10 naira of stock. 2 million of 10% convertible into stock, converted in 1 year at the rate of 3 shares per 5 naira of stock. The earnings of 2019 is 1,750,000. The income tax rate is 35%. Required, calculate the basic EPS and diluted EPS for 31st December 2019.
Okay. Therefore, you guys have 20 minutes to play with this. I'm sending you the worksheet. You can copy the templates and do it at your own pace. Please, guys, check your WhatsApp. You see it on the group WhatsApp chat. Okay, Joy, can you read the question once again and let's attempt solving it together?
Can you hear me?
Yes.
Okay. Scenario 9. Basic EPS and diluted EPS with respect to convertible securities. WORKBOOKS PLC has 5 million ordinary shares of 25 kobo in issue, and also had in issue in 2019 1 million of 14% convertible loan stock, convertible in 3 years at the rate of 2 shares per 10 naira of stock. Secondly, 2 million naira of 10% convertible loan stock, convertible in 1 year at the rate of 3 shares per 5 naira of stock. The earnings for 2019 is 1,750,000 naira. The income tax rate is 35%. Required, calculate basic EPS and diluted EPS for 31st December 2019.
Thank you very much. Okay, now I've extracted information. We have ordinary shares in issue up to the end of 2019 at 5 million shares. Profit for the year at 1.75 million naira. We have 2 convertible bonds. Okay, the first one is 14% convertible loan. The nominal price is 10 naira, and the bond value is 1 million naira. and is convertible to 2 shares per bond, and the coupon rate is 14%, which means the number of loan notes can be said to be 1 million capital divided by 10 nominal price, which means it's 100,000 bond notes here. Second note is 10% convertible loan note with nominal price of 5 naira. The bond value is 2 million. Therefore, we can simply say the loan note is 2 million divided by 5, which gives 400,000 notes. The coupon rate is 10%, and the conversion rate of the bond is 5 naira bond for 3 shares, which means for every 1 note, they get 3 shares. The income tax rate is 35%. Therefore, we want to calculate the basic EPS. Therefore, what is it? Basic EPS, at this point, there are no adjustments. It's our profit for the year divided by number of shares. And invariably, that gives us 35 kobo per share. Okay, diluted EPS. We then need to test for dilution, potential dilution for each of the convertible loans, okay? Now we'll pick the first one, 14% loan notes. Let's determine the increase in earnings, which is the savings you can have. The bond value was set to be 1 million. The coupon rate was set to be 40%, which means the interest you will have salvaged or saved is 140,000 naira. And we are also going to lose the tax effect on that interest at the rate of 35% corporate tax. It means we'll lose 49,000. Therefore, net savings is 91,000. And I'll call it net savings X1 because we have 2 types of convertible bonds that are potentially considered for dilution. Now, Y1, the weighted average number of shares. Remember, the bond loan note has been determined to be 100 loan notes, and each loan note is convertible to 2 shares. It then simply means that the potential shares is 200,000 shares to be issued. And it has stayed for 1 year, which is 12 is 1. It means our weighted average is not different from our potential shares. Therefore, we'll determine the change in EPS, which means the change in EPS is the difference that is dividing 91 by 200. What does that give us? It gives us 46 kobo. Now, there's a problem. This 46 kobo seems to be higher than our basic. It then means that it has failed the test. Now, the potential are dilutive if this is greater than this. Now, what's our answer? Since the basic EPS of 35 kobo is lower than change in EPS, which is 46 kobo, hence it is anti-dilutive. Therefore, it will be considered. That means it is anti-dilutive, it will be considered in our basic, in our diluted EPS. Therefore, we will not consider that. Okay. Now let's try the second one. The second one, bond value is 2 million. interest. So interest rate. So this is interest rate on coupon rate is 10%. Therefore, what is our interest that we are saving? 10% of 2 million is 200,000. The tax effect, which we are also going to lose as we save interest, is 35% of the 200,000, which means invariably our net savings is 130. Now, weighted average number of potential shares, what's our bond number of loan notes is 400,000. And the conversion ratio is 3 shares. Therefore, the potential ordinary shares is 4 million times 3 shares. And that is this. Now the weight is also 12/12, which is 1. And that's materially not different from what we have here. Okay, now what is our change? Our change is simply our net increase divided by our weighted average potential shares. And what do we have? Now, what do we have? We have 130 divided by 1.2. We have 11 kobo. Now, since 11 kobo, you can see that it's lower than 46 kobo. Therefore, I can come back and say 46 kobo is greater than change in EPS, which is 11 kobo. Hence, it is dilutive. This passed the test, while the first one failed the test. It then means that, what do we do here? The increase in earnings is now X1 plus X2. But unfailingly, X1 failed, while X2 passed. Also here, it will be Y1 plus Y2. Y1 failed, Y2 passed. Therefore, what are we going to input for Y1 and X1? We are just simply going to input 0 because they failed. Therefore, what we do, it will be earnings as we have it before. Sorry, this is not shares, this is in Naira. Okay, it will be what we have as our earnings before plus is 0 for X1 because we can't put it, it has failed the test from here. And therefore, it will be considered, which means not considering it is like putting a 0. While S2 passed, and in that case, we'll consider X2. Also, in our denominator, our shares based on basic EPS is 5 million plus is 0 for Y1 because Y1 failed the test. Therefore, we can't impute it, we'll substitute to 0, or we'll just ignore it as if it doesn't exist. And Y2 passed, we'll consider it. Therefore, what is our diluted EPS? Is this divided by this, and it's 30 kobo. And that is a position there, which means my diluted EPS is 30 kobo, and my basic EPS is 35 kobo. I think somebody got it right. Grace, congrats to you. That means you understood it very well. That's nice. That is a position of it, which means at every point we test for dilution. Now, if the two have been dilutive, we will not carry out additional step. And the additional step is synonymous to doing this, to see at what point is it most dilutive. And we are going to see, we are going to solve past question, the one for last diet, November 2022 of Ican. And that one has issue where you can plot this graph and see that though all of the three potential shares are dilutive, but which one is the most dilutive? We are going to see it. That is that. Any question on it? Any question on this? Any question on this? That's it. Which means this failed the test. Let me emphasize it. Failed. Failed. Yes, it is anti-dilutive. Why this passed? Therefore, it is dilutive. That is that. Now let's look at another scenario. Let's look at scenario 10. Can somebody read scenario 10 for us? Redmi, are you there? Can you read scenario 10 for us? Okay, since you are not there. Okay, Samuel, can you read for us? Okay, Precious.
Scenario 10. Basic EPS and diluted EPS with options or warrants. Ozil PLC has 2 million ordinary shares in issue as of 30th June 2019. The earnings for the year ended 30th June 2019 was 3 million naira. The company has presently issued an option of 100,000 ordinary shares written in favor of management staff sometime in 2017. The average market price of the company shares as of 30th June 2019 was 5 naira, while the exercise/strike price of the company shares was 2 naira required. Calculate basic EPS and diluted EPS for 30th June 2019.
Okay, thank you. Now I've copied the question. Now, as at 30th June, that means this year ends every 30th June. And for this year, 2019, it has 2 million shares. And the earnings was 3 million. The company has presently issued 100,000 options or warrant issued. They are alike. I remember they were considered issued over time, which means it has spent a full year. 100,000 options issued. And they are issued in form of shares. Okay, it's going to vest. It was issued in 2017. Yeah. Now the average price market price for the year of 2019 was 5 naira. Now the option was issued, the option price, or what we call exercise price, or again, you can call it strike price or striking price. In case you see it anywhere, option, exercise price, or strike price are saying the same thing. Let me write it in full. They are saying the same thing. Sometimes you see striking price. And I'll explain what it is. It's 2 naira. Okay, I think that's all of the information. Now, let's quickly just complete basic EPS. We'll come back to this. Basic EPS. Now, what's our basic EPS for 2019? Okay. Basic EPS is our earnings divided by our number of shares. Okay, and what's the answer? 3 million divided by 2 million shares. That's 1.50 naira. Very straightforward. Now the problem is this. We need to determine X and Y. Now we'll come here. What's our X? Increase in earnings. We have increase in earnings. Technical notes. When you issue share option and it's exercised, there's nothing you are saving. Unlike bond, when it's converted, interest will no longer be paid by the company. Therefore, it increases your profitability since there's no interest to deduct. But when it comes to option, you are not saving anything. All because the option is just a right you give to somebody to buy your shares at a particular point in time and at a particular price, which is usually lower than the market price. Therefore, there is no earnings that is likely going to increase as a result of holders of an option exercising those options. There's nothing you are paying before that you no longer pay again to now make it boost your earnings, which then means that in that case, there is zero increase in earnings attributable to exercising of an option. Therefore, in that case, your X is 0. Your X is what? Is 0. Take note of it. When it comes to option, your X is always going to be equal to what? 0. Options, warrant, share grant, share appreciation rights will always convert to 0. Remember, let me take you back to the notes. Remember, we had discussion on this. Now, these are potential. Therefore, once you have a share warrant, I believe I'm sharing it appropriately. Yeah. Once you have a share warrant, you have a share option, you have a share right, you have employee stock purchase plan, and contractual right to purchase shares, they are likely not going to bring about increase in earnings, which means X is always a 0 in any of these cases. Take note of it. And likewise, to some degree, this, which you might consider later. But we've tested this, but there's something I will discuss on preference shares that are convertible. They are the same thing, and they are treated the same way as convertible debt, except for something, which is a tax consequence of preference shares. I'll come back to that. Now, let's go back to our workbook. Therefore, X is 0. I then need to determine Y. Now, what is my Y? My Y is my weighted average potential shares. Now, take notes. There's a methodology that is applicable to determine our potential ordinary shares. We call it Treasury method. We call it Treasury method. Or what some people call if converted method. And I will explain. You know, when you talk about treasury shares, it means a company buying back its shares. That's what we are trying to make here. Take note of it, please. Now, what does it entail? It will entail the following steps. Step 1. Is that let's assume the options are immediately exercisable. And if you assume that, what do we need? What then is the proceeds of the options to the company? That's step 1. Now, what it means is that these people, if they exercise the option now, they are entitled to 100,000 shares, and they will have to pay us 2 naira per share, even though in the market is going for 5 naira. The question then is, how much would they pay us or deposit now to buy our shares? Is 2 naira times 100,000, which means In that case, the proceeds on the options equal the 2 naira per share multiplied by the 100,000 options. And how much is that? That will give us 200,000 naira. That will give us 200,000 naira. 2 times this. Okay, second step, step 2, is that since they exercise and they've given us 200,000, what are we meant to do is to give them 100,000 shares. Therefore, what will we do as a company with the 200,000? We will go back to the market to buy back our shares. And that is what the word Treasury is talking about. Which means if this guy converts now, which is the exercise option, we'll be forced to buy back our shares in order to deliver to them. And buy back our shares is what called Treasury shares. Therefore, it's now that we now come here and say, repurchase shares, repurchase own shares in order to fulfill the options. Therefore, we go back and buy back our shares so that we can deliver it to the option holder. The question then is, what is the number of shares we can buy back with the options proceed? Therefore, all my questions, I'll put it in red. Therefore, it will be that, remember, option proceeds equals, if you remember, this 200,000. Let me put it here. Now, prevailing average market price, if you have to go to the market to buy our shares, remember, it was 5 naira as at the end of the year. Therefore, what is the number of shares repurchased with 200,000? It is simply 200,000 naira divided by 5 naira per share. And therefore, what is that? Divided by 5. That is, we're able to buy back how many shares? We are able to buy back 40,000 shares. But these 40,000 shares is not what we promised them. We promised them 100,000 shares, but the money they gave us can only buy 40,000. What does that mean? It leads us to step 3. It means invariably we will be issuing additional shares to the options holder in excess of 40,000 shares at no cost to them. That is shocking, which means we are all aware that there's no free lunch in Freetown, but since we are giving free lunch in Freetown, which that means that we are therefore creating potential ordinary shares, which means shares that is not paid for, which is not bringing any capital in, but invariably is going to be ranking for dividend and struggling with the existing shareholders in the future. Therefore, you've created potential ordinary shares such that the options granted in shares is 100,000. Remember, but shares purchased with options monies and delivered to option holders is 40,000. Now the problem is we have created potential ordinary shares of the difference, which is 60,000. Therefore, this 60,000 is the potential ordinary shares that we have created. But take note, we still take the time proportion. The weight in this case is 12/12. Why is it 12/12? Because this scheme has been existing since 2017, which means it has stayed the whole year. And therefore, the weight in this case is 12/12. And 12/12 is 1. And therefore, I can come back and say, my weighted average of potential ordinary shares is now 60,000 times 1. And that is it. Therefore, at every point in time, take note. If you are to carry out a test, you don't even need to test for option. Option will always be dilutive. Who can tell me why? Why will option always be dilutive? It will always be dilutive because of the increase in shares and this. It will always be dilutive because it is 0 we have for our increase in earnings. Take note of this. It's contributing no earnings and we will be qualifying for shares. At the end of the day, our change in earnings is always going to be 0. And that is why when it comes to ranking, you must always rank option first because it's the most dilutive. It's giving you nothing. Unlike here, that even what we call anti-dilutive still give us something. Do you get what I'm saying now? Dilutive here give us something, but option will give you nothing, all because it's contributing nothing and is coming to share with you. Therefore, in that case, what happens? You don't need to carry out this test, but just to satisfy all righteousness, we can more or less show it, which is what I've shown here, and let me just put it here. Let me just put the narrative here. Therefore, what's our EPS? 1.5, and it's contributing what? Nothing. Whereas change in EPS is 0. Let me emphasize it, nothing. So that it doesn't shock you. Contributing nothing. Hence, it will always be dilutive. And it is the highest in rank. It's always ranking first. Therefore, in that case, what will I do? I'll come back and say, since earnings per share plus increase, the increase will always be 0. Therefore, it's just this plus is 0. Nothing will change in the numerator, but the denominator will change to 2 million plus the weighted average potential, which is this. Automatically, it gives me 1 naira 46 kobo. That is the dilutive position for it. Remember, option says you use a methodology called the if converted method. That is, if the option is exercised and there is conversion now, you will have to repurchase shares, and therefore we'll call it Treasury method, or not of, or Treasury methods. The methods revolve around about 3 steps. Step 1 is, if the option is exercised, how much will the company realize from it? And what the company realize will be used to repurchase the shares at the average market price. And it will bring about reduced number of shares, and you can't deliver 40,000 shares, you have to deliver 100. In that case, you'll be forced to deliver additional 60, which they will not pay for. And that is the position there. And that additional 60, if you consider the time proportion, will be considered as our weighted average number of potential ordinary shares. And you don't need to carry out this test, because once it is option warrants, it's always going to be dilutive and they rank first at all points in time. And that is that. Any question? Any question? Now, can somebody send okay, I should the past question. That's immediate last guide question. Let me see whether I can pull it up. Okay, I think I've seen it. Yeah. For us to attempt solving. Any question on this? Okay, I've finished it. Now, let me share it. Can you guys see it? Can you guys see it? Okay. Now let me enlarge it. No, that's not it. Okay, this is it. Question 6. Okay. Can somebody read it? Okay. Glory, over to you. We can't hear you. Okay. I think it's low. Joy, can you read it?
Okay. Can you hear me?
Yes.
Okay. IS 33. Earnings per share, EPS, requires entities to calculate basic and diluted earnings per share. However, diluted EPS and basic EPS will usually differ when there are potential ordinary shares in existence. Required: 1. Explain the term potential ordinary share, giving 3 examples as stated in IAS 33. 2. Describe the procedure for ranking when there are several types of potential ordinary shares in issue when calculating diluted EPS.
Okay, let's stop at that first.
Okay, should I?
Just hold on. Let's stop at that first. Let me take you to, although we know the answer, we've dealt with this extensively, but let me take you guys to ChatGPT and see whether GPT can equally answer it. We'll now compare what GPT will have scored if it sat in the same exam with you. Okay. Okay. Can you see the screen?
Yes,
okay.
sir.
I'll use GPT-4. It's more intelligent, it's the most intelligent to answer it. Now, this is a question. I've copied and pasted it, and let's see the answer it's going to give us. It says a potential ordinary shares is a financial instrument or contract that may entitle its holder to ordinary shares in the future. This instrument can dilute the earnings per share when they are converted to ordinary shares. IAS 33 requires entities to consider dilutive effect of potential ordinary shares when calculating diluted EPS. 3 examples of potential ordinary shares are stated in IAS 33 are convertible bonds, convertible preference shares, share options, and warrants, which we have discussed today. Now, 2, where there are several types of potential ordinary shares in issue, the procedure for ranking them for calculating diluted EPS involves determining the order in which potential ordinary shares will dilute the EPS. The ranking should be done in the order of dilutive effect, from the most dilutive to the least dilutive. The following steps should be: calculate individual dilutive effect of each type of ordinary shares by determining the incremental earnings per share that will result from the conversion of potential ordinary shares into ordinary shares. Rank the potential shares based on individual dilutive, with the most dilutive ordinary share ranked first, and that is always the options. Calculate diluted EPS by sequentially adding each type of potential ordinary shares to the basic EPS calculation, starting with the most dilutive potential ordinary shares and proceed to the least dilutive. By following this ranking procedure, entities ensure that the dilutive EPS calculation accurately reflects the potential dilution that could occur if all potential ordinary shares were converted into ordinary shares. Now let's compare that with the solution. Now I want you to read the solution and see whether, if you have scored ChatGPT, what will you have scored ChatGPT? Read the solution.
Okay. Can you scroll down? Is it?
Not down, it's already output. Yeah.
Okay. Potential ordinary share. A potential ordinary share is a financial instrument or other contract that may entitle its holders to ordinary shares at some time in the future. 3 examples of potential ordinary shares are: 1. Financial liabilities or equity instruments that are convertible into new ordinary shares at some time in the future, such as convertible debentures, convertible preference shares, etc. Secondly, share options and warrants. Options and warrants are financial instruments that give the holders the right, but not the obligation, to purchase new ordinary shares at some time in the future at a fixed price. And thirdly, shares that will be issued if certain contractual conditions are met, such as contractual conditions relating to the purchase of a business. 2. We want figure 2. Procedure for the ranking potential ordinary share. 1. When there are several types of potential ordinary shares in issue, they should be ranked in order of dilution, with the most dilutive potential ordinary shares ranked first. Second, in order to carry out the ranking, the earnings per incremental share is found for each potential ordinary share. This is the earnings adjustment that would be necessary, divided by the number of shares that would come into being if the shares were included in the calculation of diluted EPS. And thirdly, the money options and warrants always rank first, as they increase the number of shares in the calculation without affecting the earnings.
Because it contributes to zero earnings. Now, it's a 3-mark question for 1 and 3-mark question for 2. Will ChatGPT not score 6/6? Eh? That means in your mind, they should allow you, just let ChatGPT assist you a little. Okay. Now, that is that. Now, again, I'll put this for ChatGPT to solve, but we'll solve our own, compare our solution with ChatGPT, and also compare it with Ican solution. But pending that time, let me just give it to ChatGPT to solve, and we'll see what it does, even though we will not know whether it's right or wrong for now until we do our own. Can you see a rank option first? All of the steps we did is what he has done. Conversion bond, the same step we did is what he will repeat. He will do it for preference shares, but the difference between preference share and the bond is that there is no tax implication for preference shares, unlike bond. And we are going to see that. Whether it's right or wrong, it might be wrong slightly sometimes for calculation like this, depending on tax jurisdictions and some other things, but we'll check our own and see what it is. He said our diluted EPS is 225 kobo. Now let's go and solve ours. Okay, let me copy the question. Okay, now let's solve the question. Let me copy. I need this information. Okay, I'll copy other ones as we have it. Now, we have profit for the year, 80 million. Issue of shares, 50 kobo. Therefore, there are two steps to determine our number of shares. They gave us issued share capital, 3 million naira. They gave us nominal price per share, 50 kobo, 4.5. Therefore, it means our knowledge will make us determine that this divided by this, that is dividing issue share capital by nominal price, will give us 6 million shares as at end of the year. Okay, as at 31st December 2020. Profit is 50 million, yeah. The average market price of the shares. Average market price, I can copy it here. Average market price. (2020). Is 70 naira per share. Okay, it has the following financial instrument. 1, options. Therefore, I can go and copy option side. Instead of typing, I have this before. I don't need average market again. I've done it before. Now, options. How many options? 800,000 options. What's the option price? Strike price, 52 naira, 50 kobo. Also, he has 5% convertible bond of 6 million naira. Okay, therefore I can use that. 5% convertible bonds. They didn't give us. They gave us the value. They didn't give us the units. Therefore, we determine the units. They gave us the value. The bond is 100 naira bond, and the total value is 6 million. The rate is 5%. The rate is 5%. Therefore, how many bond notes will it be? 6 million divided by 100. That is 60,000 bonds. Yeah. The conversion ratio is 30 new shares for every bond. 30. Our tax rate is 30%. Okay. They also give us preference shares. In this case, in preference shares, they gave us 8% convertible preference shares. What's the value? The value is, okay, they didn't give us a value. Okay, they give us in shares. How many units? Is 200,000 units. They gave us the nominal price, price per preference shares. That's how much? 10 naira. It's convertible in 2024, is future date, yeah, at a rate of, for every one ordinary share, for 25 shares each, which is the conversion ratio. The conversion ratio is for 25 preference shares, preferred stock, to 1 ordinary share. 25 preference shares is equivalent of 1 ordinary shares. Okay. Therefore, what's preference share capital? We can determine that. Preference shares capital is our number of shares times the nominal value, 10 naira. That is in naira. How much is it? It's 2 million. Okay, therefore we have extracted all of our information. Therefore, we have how many potential ordinary shares here? I'll put them in green. We have options in green. I'll then put them in blue. We have convertible loan notes, and we have preference shares. Those are the 3 potential ordinary shares we have. We'll now test them for potential dilution one by one. Let me start with option, the one we just finished. We know that earnings is 0. Let me just copy what we have here. Okay, now let's go back here. Let me freeze this. Okay, now technical note is 0 increase in earnings for option. That's acceptable. Proceed. What is our proceed? The option is 52 naira. 52 naira, 50 kobo is what we are going to get. Times how many options? 800,000 options. Therefore, that is 52 naira times 800,000 options. That's 42,000 for 2 million. 42 million, what's the prevailing market price? We'll take it to market at 70 naira. We'll come back with 600,000 shares. Come back with 42 is what we took. 42 million is what we took to the market, divided by 70 naira. Is what gave us 600,000 shares. Now, invariably, we need to issue in excess of that 600,000. What are you issuing in excess of 2,000? Option granted was 800,000 shares. It then means you've only bought back 600. Therefore, you have to issue 200. Now, when was this option issued? It has been in existence when the option has been existing before. They didn't tell us it is during the year. It means it's going to serve a full year, 12/12, which is 1, which means this is this. Therefore, we've finished with the option, and that is that. Now, let me show you certain tests we'll be doing. Let's quickly compute basic EPS, as you always done it. Look at it. Our earnings is 18 million. Our share capital is 6 million. And this gives us 3 naira. Okay, now let's now compute as if it's only options that exist. Therefore, it will be 18 million plus 0 divided by 600,000 plus 6 million plus the 200,000 additional shares. And can you see that it's reduced to 2.90 kobo? That is number 1. Now, we are not aware again that we have convertible bond. Therefore, let me go and borrow leave from what we did under convertible bond. This is what I need under convertible bond. I copy this. I bring this here. What convertible bond is it? Sorry, it's not there. It's supposed to be here. Therefore, what convertible bond is it? It is a 5% convertible bond. $5 convertible bond. Okay, the other one was option. This is options. The second one is convertible bonds. Now, what do we need for convertible bond? We need the bond value. What is the bond value? The bond value is 6 million. What is the coupon rate? What's the coupon rate? Coupon rate is 5%. 5%. Therefore, what's the interest? The interest is 300,000. What is the tax effect? 30% of the 300,000, and that's 90. The net interest is 210. Okay. Now, we'll come here. What is our number of convertible loan notes? That is a 60,000 loan notes. Remember how we got 60,000 loan notes? 6 million divided by 100 naira. Now, what is the conversion ratio? Conversion ratio is for every 100 naira loan note, you get 30 shares. Therefore, what does that translate to? It translates to 1.8 million shares. And the bond, information reaching us is that the bond has been there before now, and therefore is going to rank for a whole year, 12/12, which is this, and therefore this is. We'll now divide 210, which is net interest savings, by 1.8, which is the weighted average number of potential shares. We've got 12 kobo. And 12 kobo compared to 3 naira shows it is diluted. Therefore, I'll come here. What we have here is 3 naira. And here we have 12 kobo. Automatically, it is dilutive. Now, if it's dilutive, let us add it here. Remember, I'll copy this here so that I can have x1, x2, x3. Now, the x2 is, the n is here, and the y2 is the weighted average here. And what do you see? Before it was 2.9, I guess. Now it is 2.28. Are you taking notes? Let me show you again. See, it was 2.9 before. Now, introducing x2 and introducing y2 has further diluted it to this. So therefore, we'll take note of this to 2.28. One is 2.9, one is 2.28. Okay, now let us introduce x3. Remember, there are 3 potential classes of ordinary shares. That's why it's x3. We'll also test for it. Okay. Therefore, let's do for y3. We use the same thing here. But the difference is I will put preference shares. It's 8% convertible preference share. 8% convertible preference shares. Okay. Now, preference share value is what we need, not bond value. The preference share value is capital is 2 million. And we need, what is the fixed dividend rate for preference shares? Okay, we didn't put it there. Okay, let me put it there first. Fixed dividend rates. Is this 8%. Therefore, I'll link it. I'll come here. The fixed dividend rate is 8%. Now, it's not interest you save. You no longer be paying fixed preference dividend, which means fixed preference dividend will no longer be paid. And you will save that 160,000. But this is where there's difference between preference shares and bond. Preference shares does not have tax advantage. What it simply means that preference dividend is not tax deductible. Preference dividend is not what? Tax deductible in Nigeria and in most jurisdictions. Therefore, the tax effect is zero. And that is a major difference there. Therefore, this is 160. Now, we'll go back again. What is the total number of preference shares we have? We have 200,000 preference shares. Is that 200,000? Okay, yes, 200,000 preference shares because it's 10 naira. Therefore, what is the conversion rate? The conversion rate for every 25 is 1 share. Therefore, for every 25, you get 1. Okay, sorry. For every 25, you get 1, yeah? Now, the question then is, the number of ordinary shares you have will now be 200,000 ordinary preference shares divided by 25. Therefore, it means you can only get 8,000 ordinary shares for your 200,000 because 25 preference share is equal to 1 ordinary shares. I think I have to reconstruct it here. This is conversion ratio of 1 ordinary shares to 1 preference shares to 25, sorry. Okay, sorry, not 1, 25, yeah. Therefore, that's how I got my 25 here. Okay, and that gives us 8. Now, the weight is 1, and that is it. Now, the question then is, increase in earnings is 160. Number of shares is 8,000 shares, and that gives us 20 naira, as the case may be. Okay. Now, take note. If that is the case, 20 naira is greater than what? Is greater than 3 naira. Therefore, it is anti-dilutive. Our come here is anti-what? Dilutive. 3 naira is lower than the change in EPS of 20 naira. Hence, it is anti-dilutive. This phrase is failed. Failed is anti. And on a normal day, it won't even go for our ranking. It's not necessary in our ranking. Therefore, this passes the test. Passed, and it is dilutive. This equally passed. It is dilutive, and we'll have to rank them. Okay, now before we rank, we find out that if we, by mistake, consider X3, instead of consider it as 0, we take this, and by mistake, we're supposed to consider Y as this. Instead of 0, you will see that our earnings per share, sorry, yeah, shows 2.29. This 2.29, what does it do? Marginally, it has started to increase, which means, look at it. Before it was 2.9, which means if you look at the graph, this is what the graph is saying. This is what the graph is saying. Our basic EPS at this point is 3.0. Now, if you look at the first one, option, it gave us 2.9, which means it's coming down. By the time we add the bond, it came to 2.28, somewhere here. And by the time we now add preference shares, it's now coming up at 2.29. Do you get what I'm saying now? Which means something is coming down like this, and there's a point of what? Inflection coming up, which means this is our lowest up, and this is where we're supposed to stop, which is this. Now, which is this. Now, what I can do is I can plot it for you in this way so that I can see it clearly. Let me plot it like this. Classes, class of shares, existing, and options, existing, options, and bonds, and third one, existing, options, bonds, even though I don't need to consider the last one, preference share, because it's the anti-dilutive, but I just want to show you. And preferred stock. Therefore, if that is the case, earnings per share, EPS, I have 3. I have 2.9. Sorry, yeah, 2.9. I have 2.28. And I have 2.29. Therefore, all things being equal, Let me say this is a table. First, remember, what's our ranking? Our ranking is such that if you are to rank, the one that has the lowest is 0. It's 0. Therefore, I'll rank this first. Rank first. I'll rank that first, sorry, superscript. I'll rank this first. Now, which one is also next to it? Between 0, 0.12, and 20, which one is closer? Is this? I'll rank this second. Normally, I'm not supposed to rank this because it's it's out of it, but I will pretend as if it's not out and rank it third. But I'm going to take it off. I just want to show you, assuming we ranked it third. Therefore, it's on that premise we've done this stuff we did here. Let us consider only option. Let us consider option and the next. And let's consider option, the next, and the next of the next, which is this. And on that basis, this is it. You now find out that it is at this point that is the minimum point. Even without plotting the graph, this is the minimum point. Because that's where you have the point of inflection. That's where you have the point of inflection, the lowest elbow. Therefore, I can plot it on a graph and see what it looks like. Let me use line charts. Now you can see this line charts. Can you see? Let me make it big. You can see that when it got to this level, it started to go up a little, and that is it. Now, if you want to see it very well, let me just start to multiply it in thousands. Let me just multiply it in thousands so that you see, I want the distance to be high so that you can see the gap. Okay, let me plot it again. Now, can you see, it's still the same thing. Now, let me just put, okay, let me do this. Now you can see it. Therefore, the lowest you can see is this one, which I can take away the thousands. And that is it. Which means this is our starting point. And this is the lowest we can ever get to. And another proof there is that we're supposed not to even consider this in the first case because it's anti-dilutive. Therefore, I'm going to remove it. I'll leave it here in the chart, but I'm going to remove it in my calculation, but I've already copied it here. Therefore, I'll remove it. This will be 0, x3, and y3, 2 will be 0, which means it will stop at 2.28. That is it. That's it for your understanding. Now, what we got is 2.28. And let's go to ChatGPT. What ChatGPT got? Okay, let's go to Ican first. Now, you can see here, Ican said not dilutive. Okay, can you see here? Convertible shares is not dilutive. I believe you can see it. But there's a mistake in what Ican did, and I'll explain. But at the end of the day, we still got the same thing at the most diluted position is 2.28 after ranking. And this is what they produced. Okay, this ranking. Now you find out that though this is ranked third, it's supposed not to even be ranked, but let's assume it was ranked the same way we have done it. This is showing 14 incremental, but our own is showing 20 incremental. Who can tell me the reason why? Our own is showing 20, their own is showing 14. Who can tell me why? Who can tell me why? And where the mistake came from? Okay, I can tell you why. They deducted tax in preference dividend. It's not tax deductible. Thank you. Samsung said tax effect. Yes, it's a wrong solution. Even though it doesn't affect the answer materially, but if it has been diluted, it might have affected the answer materially. Preferred dividend in Nigeria, whether you treat it as equity, you treat it as liability, it's not tax deductible. When I say tax deductible, you don't deduct preferred dividend in your past computation before arriving at your taxable profits. Now, the solution is wrong. Probably the examiner might have copied the question from a tax jurisdiction where dividend paid to preferred shareholder is treated the same way as interest paid to bondholder, which is in some jurisdiction, it's only dividend to ordinary shares that is not tax deductible. But in Nigeria, based on the tax law today, preferred dividend that is paid is not deductible for tax purposes. It is treated in Nigerian law similar to ordinary shares for tax purposes. And I suspect that is what happened. The examiner may have copied the question from a jurisdiction where preferred dividend is tax deductible in the same like bonds, loans, and etc. That is the only difference in it. But at least we still got the same result, just because it is anti-dilutive. The effect is not same. But let's look at ChatGPT. ChatGPT gave us 2.25 naira, very close. But I know where ChatGPT made mistake. The mistake came from the fact that ChatGPT did not consider the tax effects of the interest on bonds. And I suspect is because the jurisdiction that ChatGPT might have used is a jurisdiction that probably does not equally consider tax effects. And that's why marginally, but at least if you have to score ChatGPT over 7, according to the request of the examiner, you can see score 3 or 4. But on the first part, it scores 6 over 6. But on the second part, it's called probably 3 over 7, or maximum 4 over 7, as the case may be. Okay, and even Ican themselves made a blunder, but the blunder is not material to have caused it, which means with that, they might still score 6 over 7 or 5 over 7. Luckily, because though we arrive at the same position of anti-dilutive, and it was not considered in the computation, we are still able to get something similar. And that is that. Any other question to that? Now, these are limitations of ratios of earnings per share, as the case may be. And can somebody read these limitations of earnings per share? Samson, over to you.
Can you hear me?
Yeah, we can hear you.
Limitations of EPS. One, not all entities use the same accounting policies. It may not always be possible to make meaningful comparison between EPS of different entities. Two, EPS does not take account of inflation. Therefore, growth in EPS over time might be misleading. Three, EPS measures an entity's profitability, but this is only part of an entity's overall performance. An entity's cash flows can be just as important as its profits and more essential to its immediate survival. Changes in the value of assets that it is holding gains can also be an important part of performance for some entities. 4, diluted EPS is often described as an early warning to investors that the returns on their investment may fail sometimes in the future. However, diluted EPS is based on current earnings, not forecast earnings. This means that it may not be a reliable predictor of future EPS. 5, EPS is not a complete tool for investment analysis, as it cannot provide information on the liquidity position of the entity.
Thank you. Now, can you also read the examiner's comments or report? Samson.
Examiner's report. The question is on provisions of IAS 33 earnings per share, and it also tests candidates' knowledge of computation of diluted EPS and limitation of EPS as a means of determining an entity's performance. Most candidates attempted the question, but performance was poor. Majority of the candidates could not explain and state the types of potential ordinary share, while others could not calculate diluted earnings per share for options, convertible bonds, and preference shares.
Okay, thank you very much. Okay, now let's look at, let GBT tell us what limitations of EPS are, so that we can probably benefit from what it is. Let's see what it says. EPS is widely used as a financial metric that present portion of company's profit allocated to each outstanding shares of common stock, that is ordinary shares. While EPS is useful tool for investors to guard against a company's profitability and performance, it has several limitations: lack of comparability, earnings manipulation, focus on short-term performance, ignoring non-recurring items, dilution. Basic EPS does not account for diluted effects, and that's why we are also required to disclose diluted. No concentration of risk in it, that's another factor. Another one is overemphasis on earnings by neglecting other measures like cash flow, return on equity, dividend payout, and co. In summary, why EPS is valuable financial metric, it should be used in conjunction with other financial ratios and metrics to provide a more comprehensive view of company's performance. Investors should also consider effective factors such as earnings quality, competitive position, and industry outlook. Okay, I'll copy that and send to you guys. Okay, let's go back to this. And we are wrapping up now. And this is a task for you to do. But before the task, I want somebody to read this disclosure. iPhone, can you read the disclosure? iPhone. What do you need to disclose? Okay, Glory, over to you.
If EPS is presented, the following disclosures are required. Number one, the amount used as the numerator is calculating basic and diluted EPS, and a reconciliation of those amounts to profit or loss attributable to the parent entity for the period. Number two, the weighted average number of ordinary shares used as the denominator in calculating basic and diluted EPS, and a reconciliation of this denominator to each other. The third one, instruments in brackets, including considerately issuable share that could potentially dilute basic EPS in the future, but were not included in the calculation of diluted EPS because they are anti-dilutive for the period presented. The fourth one, a description of those ordinary share transactions or potential ordinary share transactions that occur after the balance sheet date and that will be changed significantly the numbers of ordinary shares or potential ordinary share outstanding at the end of the period if those transactions had occurred before the end of the reporting period. Examples include issues and redemption of ordinary shares, issues of cash, warrants and options, conversion and exercises.
Okay, now can you read this comprehensive question, which is a task and assignment for you guys, and read it out.
Okay, complex examination question. Paramola PLC has 1 million ordinary share in issue as of 31st March 2019. The profit after tax for the year was 5 million naira. There was an issue of 100,000 ordinary share on 1st July 2019 at 1 naira, 1 naira 10 kobo, which represents full market price as of that date. The company repurchased 20,000 ordinary share, a special class of its existing ordinary share that rank for dividends equally like any other ordinary share. On 31st July 2019, the company issued a 2-for-5 right issue for existing ordinary shareholders. As of 30th September 2019, at a price of 3 naira 90 kobo, when the average market price as at the same date, same period stood at 4 naira 35 kobo, which has been fairly stable till the end of the reporting period. On 1st January 2020, a bonus of 1 naira for 10 ordinary share was issued to existing ordinary shareholders at the close of the business on 31st December 2019. Required, calculate basic EPS for the period ended 31st March 2020. 2, given that the company issued a 50,000 shares option on 1st October 2019, which is exercisable no later than 31st March 2020, which has a strike price of 3 naira 20 kobo per share. Determine the diluted EPS for the period ended 31st March 2020.
Okay, that is that. I believe the question is highly comprehensive, and I believe you guys can deal with it as the case is. If there's any other question, you can always reach out to me on the various platforms. Any other question? I think I can, let me allow you guys to unmute yourself. And if there's any other question, please kindly ask before we close the section. Okay, in the absence of none, thank you very much, and God bless you guys. and try to relax a little before the next class starts. Probably the next class might start later than 4. I'll try and talk to the next facilitator.
Hello, sir.
Yeah, hello? Yeah.
Okay, I just want to ask, which past question is that? Which year is that?
Last diet.
The last time. Okay.
It shows you didn't even look at it. You have not been looking at it. You just
No,
reported yourself.
Okay. Thank you, sir.
Yeah, thank you. Okay. Any other one? Okay. In the absence of none, thank you very much. And God bless you guys. Yeah.
Amen. Thank you, sir.
Yeah, bye.
Okay. Thank you, sir.
Bye, sir.
Bye, sir.
Bye-bye.
Bye.